The views expressed in this video are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.
Welcome to America's Gold Authority podcast. My name is Mike Barnes. You may have seen the stories that QT is ending in December. Well, those acronyms can be a little scary and confusing. So let's go to our experts and find out about what is quantitative tightening and how does it affect you. Philip Diehl joins us, and so does Brad Chastain. And Brad, I want to start with you as the Director of Education for U.S. Money Reserve. Tell us, what is QT?
Quantitative tightening is what QT stands for, is one of the tools that the Federal Reserve has in its belt to ultimately manage the size or the amount of bank reserves that are out there in the system. A lot of people are familiar with the opposite, which is quantitative easing that they started doing to a huge degree after the global financial crisis. And what these it's them expanding or contracting their balance sheet in terms of how many reserves they're offering, but also the amount of assets they're holding, primarily U.S. Treasury bonds and mortgage-backed securities. So if they want to increase the amount of reserves out there in the system, what they were doing back in quantitative easing is they were going out and purchasing bonds from banks and then adding them to their balance sheet. And now quantitative tightening is what they're announcing it into. That is where they've been letting these bonds roll off of their balance sheet without replacing them, so that the amount that they're holding is smaller and smaller. And as it becomes smaller and smaller, they're buying fewer and fewer of them. More of those bonds are then sold to the market. And ultimately that ends up decreasing, lowering the amount of bank reserves in the system. So the amount of sort of money at the Fed that the banks hold that they use to be able to engage in their business, to create credit, lending, and things like that. So it's really a way to, on the banking side, start controlling banking activity.
And Philip, as the 35th Director of the United States Mint and President of U.S. Money Reserve, you know the Fed has lots of tricks up their sleeve, different tricks to use to try and change the economy.
Yes, that's right. And QE and QT are only two of them. There's been a whole set of acronyms that have been used, different facilities that the Fed has created in the wake of the global financial crisis, as it has tried to manage the need for credit and broader monetary policy. So, and interest rates are, of course, are the best known of those mechanisms, and the federal funds rate in particular, the rate that is charged for loans between banks, overnight loans, and the like.
Brad, as we're looking at the economy over the last, 17 years since the global economy had such a crash, why now? Why is QT ending now of all times?
There's always been a plan by the Fed to so-called normalize their balance sheet. I think if anybody's looked at the trend of their balance sheet since the global financial crisis, it's hard to pin down what normalizing means at this point, except steady expansion for the most part. So they spent much more time expanding it than contracting it, but it became pretty clear right now that was going to be coming to an end, because the Fed started to lose over the last month or so control of one of the only things they actually control, which is short-term rates. So everybody knows that the Fed is responsible for interest rates. What a lot of people don't realize is that they only set one rate. It's the federal funds rate, which isn't even that big of a part of the market anymore, and it's not one we access. It's interbank lending from one bank to another. And so that's why when they lower rates, it doesn't necessarily mean that your mortgage goes down or the 10-year Treasury goes down or anything like that. But the federal funds rate, it's a proxy. Even Ben Bernanke, by the way, once said there's nothing magic about the federal funds rate. It's just a way for us to communicate what our policy is. And so what the federal funds rate is designed to signal is where they want very short-term lending rates. Some of the most important markets in the entire world that hardly anybody knows even exists in the world, unless they're in the financial industry, is something called the repo market. There's more than $3 trillion globally. $3 trillion is centrally cleared that we can see every single day. There's a lot of bilateral one-off, that's actually a bigger market that we don't have much insight into. But what we see every day very clearly is 3 trillion basically every day of borrowing and refinancing that has to be repaid the next day. And it's critical. It's a bloodline for the global financial system in the banking and financial sectors. And what we've seen recently is the rates that those are charging, while they don't target specifically, they are very much trying to influence and set a ceiling on what those rates are through their federal funds policy. They actually lost control over it over the last few weeks, where it was trading up to 0.2% above that, which is just what they were trying to cap it at, which is just absolutely unheard of. And what that shows is extreme stress, extreme liquidity stress in the system, not enough available cash to circulate. And so that's where you start seeing echoes of things like 2008, because that's what that was. That was credit seizing up, nobody being able to borrow, no liquidity in the markets. And that these are signs that sort of issue is bubbling there.
So many big numbers out there that affects the central banks, but Philip, how does it affect you and me?
Well, the Federal Reserve, as Brad was describing, the Fed sets the federal funds rate, which is this rate that is charged in interbank lending over very short periods of time. But surrounding the Fed's policy making are real market forces. And when those market forces begin to overtake the ability of the Fed to manage interest rates, then we have, or the Fed has a problem. And so they must take some kind of action in order to reestablish their ability to manage interest rates and the larger economy. And that's crucial because, especially these days, because the Fed is fighting on two fronts. It is fighting what looks to be the weakening of the economy, certainly a weakening of the labor economy, and also signs that the battle against inflation has stalled and may be reversing. And so the interest rate, that federal funds interest rate, is the tool by which the Fed manages that dual mandate that it has to reach the lowest practicable unemployment while also keeping inflation in check. So that's just a crucial key for the Federal Reserve to do its job. And when market forces begin to overwhelm the Fed's ability to manage that rate, then the Fed is really forced to make a move in order to reestablish its control.
And I think it affects so many of us in so many different ways. But I think the biggest thing a lot of people want to know is, well, if I'm invested in the stock market, especially with the AI bubble that's out there right now, Philip, how does it affect me there right now?
This is a real problem. I'm a believer that the AI bubble is real. These extraordinarily high valuations have become detached from the reality of what these companies can ever produce in terms of revenue and therefore profits. I think there is significant vulnerability to contagion because of the role that index funds now play in investments for individuals, and also because of the immense concentration of economic wealth in the Mag 7 and the constellation of companies around the Mag 7, and just the whole issue of whether or not AI can ever become profitable and how long it will take before it does become profitable. And there is an interaction between the stock market generally, and especially a vulnerable stock market, the prospect of a crash, and illiquidity. When tremendous amounts of wealth are taken out of the marketplace because of a decline in market capital or because of the decline in the value of assets that people hold, then that creates a illiquidity crisis and makes people also more inclined to stop spending and to stop the circulation of money in the economy. So these forces all face each other and reinforce each other in the event of either a liquidity crisis or a stock market crash or an AI crash. And really, an AI crash will be a stock market crash. They're so interrelated now that it's hard to imagine that the Mag 7, the big AI companies, could crash and not bring the S&P down with them.
And the word liquidity, we're using it, but not everybody may understand what that really means out there. So it depends on the way it's being used, but in the way that we're talking about it here with the market, it really is the sort of the cumulative buying power that can support asset prices. So it's a combination of how much money is out there and how much of it's circulating and available to chase asset prices. It has to do with the availability of credit. Are banks lending money freely and willingly, and are people wanting to borrow it? Do they have a risk appetite to lend? Do others have a risk appetite to borrow and use that and deploy that money? So it's a combination of those things that drive how much buying power there is. And when all of that is just humming along and liquidity is growing and it's expanding, you can think about it like the tide rising. The phrase, a rising tide lifts all boats. Well, rising liquidity tends to lift all asset prices, regardless of what's happening in the real economy. And so that gets people confused a lot of times about what's going on in the economy and markets. But it's because as liquidity becomes available, it has to go somewhere, and people end up buying assets. And so you always have some level of liquidity that supports safe assets, but as more and more becomes available, safe assets don't keep getting pushed up too much. It starts flowing into the riskier and riskier things, like we've seen over the last couple of years with cryptocurrency and AI investments that have pushed them to extreme valuations. But when liquidity goes out, like what we have seen over the last few weeks with how expensive that credit piece of liquidity has become on the short-term side, those are also the first ones that start really feeling the impact, and they're the furthest ones to fall as well. Even safer assets can eventually fall if the tide goes way out, to stay with that analogy, but they don't tend to fall as much. So it's not just, there is capital movement, right? So but people will sell one asset and move to another, but a big part of it is that the available buying power for all assets is actually declining. It just doesn't decline evenly across them. So that's why this last couple of weeks, really, we've seen things like the really sensitive ones, cryptocurrencies, AI tech stocks, have just been getting hammered, especially this week.
Brad, I love your boat analogy, but I guess individually what I'm worried about is that water getting so high that my boat topples over. What do I need to do to make sure that doesn't happen?
That's where, again, it doesn't move all assets at the same time. So that is where diversification comes in. We've seen gold hold its own in the sell-off of other things this week because, again, it's one of those safer assets to be holding that is not so sensitive like the more speculative ones, and even the market in general. So having a portfolio of different things that have different risks, because liquidity and market risk are one type of risk, there's others out there. You always want a diversified portfolio, but for these types of events, things like gold are a nice safe haven and hedge against those risks.
Oh, yes, absolutely. And there's there's one thing I think our clients really ought to be keeping in mind, and that is it's one of the reasons why the liquidity issue is so important to gold buyers and and gold holders, and that is that we see that the Federal Reserve has become concerned enough about liquidity and the potential for liquidity crisis that is using one of its tools in order to address it. And that is, it has ended QE, and which it had done in the past, and had been into QT, and now has ended QT and stopped QT in the face of these growing credit pressures. Another tool that is in the Federal Reserve quiver is the possibility of lowering interest rates. And so, and a further development of a liquidity crisis could push the Fed to lower interest rates, even in the face of growing concerns about inflation. That push to the mandate to avoid a liquidity crisis could push the Fed to raise that as a priority over fighting inflation. And if the Fed were to begin to lower interest rates for this purpose, well, that would be good news for gold. We've seen some softness in gold prices as questions have developed about what the Fed's intent is and what the expectation is for additional interest rate cuts. And one of the reasons why that has an impact on gold prices, only one of the reasons, but an important one, is that higher interest rates in the United States compared to other countries firm up the value of the dollar. And so a cutting of interest rates in order to deal with a liquidity crisis is likely to raise gold prices as the value of the dollar declines along with interest rates. So that's really something I think is important for our clients to watch, is for the possibility of lower interest rates, either because the economy is weakening or because the Fed's hand is forced through concerns about liquidity.
Just another example that there are so many factors to keep our eyes on. And Brad, we've also talked about some risks that are out there right now.
Yeah, one of them that a lot of people I don't think are very familiar with is what's going on right now with what we talked about, with these short-term funding rates and the stresses there, and the entire U.S. Treasury market. There is a trade that hedge funds have been engaged in for quite a while now. It's been scrutinized by regulators as a systemic risk out there, but nobody's really done anything about it because it's kind of become integral to support liquidity within the Treasury market as more and more debt has been issued. And it's called the basis trade, but without going into all the details of what that is, it's a very, very highly leveraged trade, meaning hedge funds borrow a lot of money, specifically in the repo market that we were talking about a little while ago, short-term rates. And there's a couple legs of the trade, but they ultimately end up buying treasuries. And just in the middle of October, Treasury came out and said they have been grossly undercounting how much has been wound up in that trade. In fact, we found out last month the Cayman Islands is the largest holder of U.S. Treasury debt. Used to be Japan, followed by the UK. Cayman Islands has always been pretty big down there, about 4, but that's because of hedge funds set up there. Turned out they have over $1.4 trillion more treasuries than had previously been counted. So it basically makes the Cayman Islands and these hedge funds as large as the entire holdings of Japan and the United Kingdom. And it's important to understand is that these are leveraged about 50 to 100 is where estimates are, to 1 in leverage. And when short-term borrowing costs like that, like the repo market's getting out of hand for the Fed, when that goes up, what that means is that it's more for them to service the debt that they use to buy those treasuries with. And ultimately, if they end up underwater, it's no longer profitable for them to hold the treasuries because they're ultimately going to be selling them. They've already agreed to sell the treasury at a slightly higher price at some point in the future is the other part of that trade. When that carry becomes negative because of a slightly higher funding rate that they're having to pay, guess what they have to do? Sell the treasuries. As more of them start selling treasuries, it puts downward prices, means more of them end up going underwater, and it's a mechanical sale that is forced, and it's extraordinarily quick. It's much more dramatic than other central banks deciding they don't want to hold U.S. treasuries anymore and gradually selling them over time. This is a forced massive sale, and the trade is absolutely enormous at this point in time, much, much bigger than it was in 2020, the last time that trade started to blow up and the Treasury had to come in and support, the Federal Reserve had to come in and support the Treasury market. So this is a big systemic risk out there. It doesn't mean it's necessarily going to blow up, but when what we're seeing right now starts happening, that is the exact type of trigger that can sort of set that ticking time bomb off. So hopefully nothing comes of it, but it is a landmine.
Brad, I want to follow up with a question on that. We've been told over and over again that various sectors of the economy, like commercial real estate, the cryptocurrency, while they may be vulnerable, none of them are as big as housing was going into the 2008 financial crisis. Therefore, we didn't have so much to worry about. There might be a shock to the system. We might even have a recession, but it wasn't going to be a big financial crisis. Tell me how the basis trade measures up. Is the basis trade large enough that it could trigger a major global financial crisis?
If it unwound in a significant way, yes. You could have a partial unwind like we did in 2020 that they were able to sort of support, but now it's so much bigger, we don't know. It's one of those unknowns that nobody can really quantify. But if the entire trade blew up, for sure, it'd be like Japan and UK selling all of their treasury debt, within hours of one another. And what people don't realize is it's not just about U.S. Treasury debt. U.S. Treasury debt underpins the entire global and financial system. The repo market we just talked about, moving money around, all of that is collateralized with treasuries. It's the basis for creating additional money that has to exist in the economy for it to continue to function. So just like in the 2008 housing crisis, that was certain types of mortgages that became illiquid. Those were being used as collateral to grow the money supply and provide liquidity to the rest of the market. And that's what made a small part of the U.S. economy, subprime mortgages, become a global issue because of the way that was intertwined. Well, the way that treasuries are intertwined in that same sort of mechanism to create more money and circulate money around the globe, that's orders of magnitude bigger. I wouldn't even be able to quantify it than what subprime was in terms of their relevance.
And so, like in 2008, it sounds like, of course, in 2008, part of the problem was we didn't have, and regulators didn't have, insight into the size of the problem or the nature of the problem because of the lack of regulatory tools to be able to identify and to take preemptive actions on the industry. It sounds like the basis trade shares that vulnerability, the lack of insight, the opacity of the trade.
Yeah, considering that just last month the Treasury announced that $1.4 trillion had not been counted for, it wrapped up in Cayman Islands and those hedge funds doing that, I think is pretty significant. To give you context, that is because this is year-end 2024 is what that's counted. So we don't even know how much it's grown, even now in 2025. But that is about 37% of all of the Treasury debt that was issued during 2023 and 2024.
Yeah, that would have a huge impact on the bond market, and it would spread into equities around the world, I would assume.
The entire economy, equities, literally everything. Because again, treasuries as collateral for the monetary system means that the entire monetary system loses overall liquidity when that collateral loses value. Just like when housing prices fall and mortgages aren't worth as much, the everything that is levered off of that is not worth as much. And it's much, much bigger than what the housing market was.
Well, I'm still going back to Brad's boat analogy and then saying underwater, which has me a little bit uneasy, but it's good to know that gold is a safe haven, so we can always find comfort in that, Philip.
Yeah, absolutely right. That's really what we're talking about is gold is a means of protecting your wealth outside of the turmoil that we're describing here in all aspects of the economy. And that's why it's one of the reasons why in the face of all the uncertainty, the geopolitical and economic uncertainty in the world, we've seen this remarkable increase in gold prices over the last 2 years. And one of the reasons why I'm convinced, and it's not just me, it's the other major analysts in the marketplace are convinced that gold's rally is not finished. There are very reasonable projections of gold prices hitting $5,000 an ounce next year. I think it's probably going to happen by the middle of next year, but and significantly higher prices beyond next year.
It's a good safe haven to have and a great director of education to have. Brad Chastain, thanks so much for educating us so much about QT today.
Thank you, Mike.
And Philip, thanks so much for joining us as always.
Thank you, Mike.
That is all the time we have for today's episode. On behalf of all of us here in the U.S. Money Reserve Studios, thank you so much for tuning in. If you have any questions or you want to learn more about today's episode, you can call the number in our episode description and speak with one of our friendly account executives. They will be more than happy to answer any questions you may have about precious metals and the strategic role they can play in achieving a secure and comfortable financial future. I'm Mike Barnes. We'll see you next time on America's Gold Authority podcast.
The markets for coins are unregulated. Prices can rise or fall and carry some risks. The company is not affiliated with the U.S. government or the U.S. Mint. Past performance of the coin or the market cannot predict future performance. All calls recorded for quality assurance. Offer void where prohibited.